In January 1945, the ballroom of the St. Regis Hotel in New York was thick with cigarette smoke and quiet calculation. Delegates from Saudi Arabia and representatives of Standard Oil of California leaned over a polished table to sign documents that would formalize a partnership already years in the making. The war in Europe was not yet over. Tankers still crossed the Atlantic under naval escort. Yet ink met paper, and with it came a commitment: American capital and engineering in exchange for long-term access to Arabian crude. The signatures did not cause a public stir. There were no cheering crowds. But the agreement strengthened what would become the Arabian American Oil Company, Aramco, and secured a flow of energy that would outlast the war. In the decades that followed, pipelines would stretch across deserts, tankers would crowd new terminals, and a kingdom built on pilgrimage and trade would anchor itself to global finance. The balance of power would tilt, not in a single dramatic shift, but through contracts, shipments, and steady streams of oil. By the early 20th century, industrial economies had outgrown their earlier fuels. Coal had powered the steam age, feeding railways and steel mills from Manchester to the Ruhr. It was bulky, dirty, and geographically concentrated. Nations with coal seams possessed an advantage that was as much geological as political. But coal had limits. Steam engines were heavy and slow to start. Naval fleets burned mountains of it and required frequent refueling. Merchant ships lost precious cargo space to bunkers. As internal combustion engines matured and automobiles multiplied, oil offered something coal could not: higher energy density, cleaner combustion, and the ability to move with relative ease by pipeline and tanker. The shift was gradual at first. In 1912, Winston Churchill, then First Lord of the Admiralty, made a consequential decision. The British Royal Navy would convert from coal to oil. The move promised faster ships and longer range, but it also created a vulnerability. Britain had coal at home. It did not have oil in comparable quantity. Securing reliable access became a strategic necessity. That necessity drove financial innovation as much as it did diplomacy. In 1914, the British government acquired a controlling stake in the Anglo-Persian Oil Company, locking in supply from fields in what is now Iran. The investment was not a subsidy in the abstract. It was a calculated hedge against dependence. The state took equity in a private company, accepted the risks of exploration and price volatility, and in return secured preferential contracts for its navy. Oil was no longer just a commodity. It was a lever. As demand accelerated, the mechanics behind oil's rise became increasingly complex. Exploration required capital long before a single barrel reached market. Geologists surveyed vast territories with little guarantee of success. Drilling rigs, pipelines, storage tanks, and refineries had to be financed and built in sequence. Each stage depended on the next. Companies developed integrated structures to manage this chain. Firms such as Standard Oil in the United States did not simply drill wells. They owned pipelines, refineries, railcars, and distribution networks. By controlling multiple stages, from extraction to retail, they reduced uncertainty. If crude prices fluctuated, refining margins or retail sales could offset losses. Scale allowed them to negotiate lower transportation rates and stabilize supply. Investors were drawn to this apparent stability. Shares in major oil companies traded on exchanges in New York and London. Capital flowed from urban financial centers into remote oil fields in Texas, Baku, and the Middle East. Risk was dispersed across thousands of shareholders. Dividends were funded by a commodity that factories, ships, and eventually households could not easily do without. Governments, too, adjusted their fiscal systems around oil. Concession agreements granted companies the right to explore and extract in exchange for royalties and taxes. In some regions, initial contracts heavily favored foreign firms, reflecting disparities in bargaining power and technical expertise. Over time, producing states renegotiated terms. Revenues from oil began to finance roads, schools, and administrative structures. In countries such as Venezuela and later Saudi Arabia, national budgets grew increasingly dependent on the price of a barrel set in distant markets. Transportation amplified oil's influence. Pipelines stitched together inland fields and coastal ports. Supertankers, far larger than earlier vessels, carried millions of barrels across oceans. The Suez Canal and later the Strait of Hormuz became critical choke points. Insurance markets in London assessed risk premiums based on political stability along these routes. Banks extended credit against shipments in transit, confident that global demand would absorb the cargo. By mid-century, oil had become embedded in the monetary architecture of the international system. After 1944, the Bretton Woods framework linked major currencies to the US dollar, which in turn was convertible into gold. As American companies expanded production at home and abroad, oil transactions were increasingly denominated in dollars. The currency of a single nation became the medium through which much of the world's energy was traded. This arrangement deepened in the 1970s. In 1971, the United States ended the dollar's convertibility into gold, reshaping the global monetary order. 2 years later, the Organization of the Petroleum Exporting Countries, OPEC, founded in 1960 by Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela, demonstrated a new kind of coordination. During the 1973 oil embargo, member states curtailed exports to certain countries in response to geopolitical tensions. Prices rose sharply. Importing nations confronted fuel shortages and inflation. The episode revealed how concentrated supply could influence global finance. Higher oil prices transferred vast sums from consuming to producing countries. Petrodollars accumulated in the banking systems of New York and London. Commercial banks recycled these deposits as loans to developing economies, extending credit on the assumption that growth would continue and energy demand would remain strong. The mechanism linked oil wells in the Persian Gulf to infrastructure projects in Latin America and Africa. It also carried risk. When interest rates rose in the early 1980s and growth slowed, many borrowing countries struggled to service their debts. A commodities price had reverberated through sovereign balance sheets and international banking. Meanwhile, producing states recalibrated their role. National oil companies gained prominence. Saudi Aramco, fully nationalized by 1980, became not only an operator of fields, but a manager of long-term production strategy. By adjusting output within OPEC frameworks, it sought to influence price stability. The objective was rarely to maximize short-term revenue alone. It was to preserve market share and ensure that oil remained central to the global energy mix. Financial markets evolved in parallel. In the 1980s, futures contracts for crude oil began trading on exchanges such as the New York Mercantile Exchange. These contracts allowed producers, refiners, and airlines to hedge against price swings. A refinery could lock in a purchase price months in advance. An airline could stabilize fuel costs for future routes. Speculators, in turn, assumed the risk in exchange for potential profit. Oil had moved from physical barrels to paper claims, from desert fields to electronic trading floors. Price discovery became continuous. Expectations about economic growth, political tensions, or inventory levels were reflected almost instantly in futures curves. Power shifted accordingly. Nations that controlled large reserves wielded influence not only through supply, but through their position in financial markets. Countries with deep capital markets and stable currencies shaped the terms of trade and settlement. Shipping lanes were guarded, strategic petroleum reserves were constructed, and energy ministries monitored not just wells, but bond yields and currency flows. Yet the structure retained certain constants. Exploration remained capital-intensive and uncertain. Infrastructure required long planning horizons. Consumption was widespread and embedded in daily life, from fertilizers derived from petrochemicals to plastics in household goods. Oil's versatility sustained its relevance. By the early 21st century, new technologies such as hydraulic fracturing altered production patterns. The United States, once seen as a declining producer, experienced a surge in output from shale formations. Global supply diversified. At the same time, emerging economies in Asia increased demand, tying oil more closely to patterns of urbanization and industrial growth in China and India. Despite these shifts, the fundamental architecture persisted. Capital raised in financial centers, extraction in geologically favorable regions, transportation across maritime corridors, pricing in global markets, revenues flowing into state budgets and corporate dividends. Energy policy and monetary policy intersected more often than they did in the coal age. The resource that had once powered kerosene lamps had become entwined with exchange rates, sovereign wealth funds, and pension portfolios. Norway's government pension fund Global, financed largely by North Sea oil revenues, invested in equities and bonds around the world. Gulf states built financial hubs and airlines with hydrocarbon income. Oil wealth was transformed into diversified assets, extending its influence beyond the wellhead. At each stage, the distribution of power followed the structure of finance. Those who controlled reserves negotiated from geological strength. Those who controlled capital markets shaped contracts and liquidity. Those who controlled shipping lanes ensured continuity. Influence was rarely absolute. It was conditional, negotiated, and reinforced through institutions. The 1945 agreement in New York was one expression of this pattern. It linked American corporate finance to Arabian geology at a moment when the modern energy system was still consolidating. Similar agreements unfolded elsewhere: joint ventures, production-sharing contracts, nationalizations, and listings on stock exchanges. Each reflected the same underlying reality. Oil required organization on a global scale. What endured was not merely high consumption or periodic price shocks. It was a network. Pipelines under deserts, tankers crossing straits, traders monitoring screens, finance ministers balancing budgets against benchmark prices. The system adjusted to wars, recessions, and technological change. It did not remain static, but its core logic, energy as the foundation of industrial and financial power, remained intact. On a quiet stretch of Saudi coastline at Ras Tanura, tankers still dock beneath the desert sun. Crude flows through loading arms into steel hulls bound for distant refineries. Clerks review manifests. Digital systems track each shipment's destination and price. The movement is steady, almost routine. From such scenes, repeated over decades, a resource reshaped empires, currencies, and markets, one cargo at a time. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.